Good morning. I'm Afsaneh Beschloss, CEO of the RockCreek Group, and I thank you for joining us this morning to talk about global markets. We're very, very fortunate this morning to have Dr. Alan Greenspan with us and Liaquat Ahamed. Most of you have heard both Dr. Greenspan and Dr. Ahamed on our previous calls, so they don't need much of an introduction. But as you well know, Dr. Greenspan, who is best known for having been Federal Reserve Chair for 19 and a half years. Did I get that right? You also have to, if you haven't already gone to the bookstores and bought Capitalism in America, you have to order it on Amazon or go to the bookstore and get it. It's an epic book that traces the evolution of innovation and entrepreneurship in America, and we'll also touch on the book at the end of our call today with Dr. Greenspan. We're also fortunate to have Dr. Ahamed with us. Liaquat spent about 25 years as an investment manager, but he is most sought after by many Fed chairmen and central bankers all over the world. And of course, we know him also for his book, Lords of Finance, the Bankers Who Broke the World, that won a great Pulitzer Prize for history. Since our last call, a lot has happened. We had much happen in the markets. The VIX hit a big high after many, many years. Last year, towards the end of the year, we had the markets have one of their most volatile periods in December of 2018. And we are seeing a major economic slowdown. It's almost like we went from supposed synchronized growth to synchronized slowdown all over the world. So a lot of interesting topics to touch upon. In terms of what happened at the end during 18, but particularly those last moments as we had that huge whiplash in the market, I was curious to know what surprised you both. Dr. Greenspan, do you want to go first?
That it came as a surprise. We have a very unusual government, and the usual means by which we evaluate it historically don't apply in this context. So the markets are trying to figure out what the President of the United States is thinking before he does, or neither one of them seem to get it right.
That is very true. Liaquat?
I would put emphasis on the Fed. Towards the end of last year, they were unusually hawkish in suggesting they were going to raise rates by another 75 basis points in 2019. And then they turned on a dime and left us with the expectation currently that there will be no rate hikes next year. And that 75 basis points change in expectations, I think, explains why the market went down so much in December and why it's come back up so much in January. Inflationary expectations stopped going up. Growth expectations were revised down modestly, but they were really revised down outside the US. And I think that's the fascinating thing, that we seem to be getting a global, a coordinated global recovery.
A synchronized
yeah, exactly.
slowdown, yeah.
And now we've got a slowdown.
Yeah.
And it's driven, as far as I can tell, largely by China. Even the slowdown in Europe can be attributed to the fall in Chinese demand for German exports and European exports. And the question of where China goes is, I think, the central question in figuring out sort of investment strategy over the next year. What happens in China has repercussions not only in emerging markets, but in developed markets. I think the interesting question is, one, what are the consequences of this trade negotiation that's going on? And does that have the potential I don't see it has the potential to revive growth in China. I mean, I just don't see how that's gonna happen. So it can only be a negative for growth in China, and it's really so. The expectation that this is going to sort of change the dynamic is I think misplaced.
You see more downside then.
Oh yeah. I mean, even if they do a deal, the deal will subtract growth from China and might marginally add growth here, but not much.
Insignificant.
Yeah.
Alan, what is your thought about what's going on the tariff negotiations between U.S. and China? Where do you think we'll end up?
First of all, let's remember what a trade war is. The winner of a trade war loses, because what a trade war is taxing your own people. A tariff is an excise tax. It was originally a means, the primary means in the United States of raising revenue. Now, if you're going to tell me that somebody's economy expands and beats the competition by taxing itself, I have to go into a different profession. And it's very obvious that what is happening is that both China and the United States are being impacted by, one, the actual tariffs, but two, more importantly, the expectations of what everybody's talking about. And I don't think, I cannot believe that President Xi doesn't fully understand it. I can fully also suspect that his opponent in the debate doesn't understand it at all. But the point here is that the winner of a tariff war is basically the one who loses the least. But they're both losing, and that's scarcely the type of battle which the rest of the world ought to be as concerned about as apparently it is.
The interesting thing is that the rest of the world also was very worried about China IP issues and China generally in trade. So it was not just the US versus China. I think it sort of maybe politically became that. But it seems like emerging markets, Europeans, Asians, and the US have a common interest in getting China to be more open.
I think the bigger IP issues, put it this way, I think going forward, once the trade is out of the way, and I don't think will end up being a big deal, because I don't think President Trump is keen on launching a major trade war. So he's always backed away from. He talks tough, but he always eventually does a deal. The IP issues are much more deep-seated and much more problematic, because I don't think. I think the perception that China does not play by the rules of the rest of the world is now very much ingrained, and it's an issue both in the US and Europe. And I don't think China intends to play by the rules. So I think this is going to become, the dynamic between China and the rest of the world, I think, has fundamentally changed.
What I find peculiarly ununderstandable in our position with respect to tariffs is we're trying to resurrect in the United States the steel industry, the aluminum industry, and all the industries that thrived and were the dominant forces in the United States in 1960.
Coming back, one of the topics that Alan talks about, coming back to the US, has been stagflation. What we hear about all the time in the last month or two has been the US is going to experience a recession maybe at the end of 2019, 2020. What is your thoughts about recession or stagflation, and And has anything changed in your thinking, really?
Well, if you take a look at the budget, the federal budgets, we're going to be running $1 trillion deficit this fiscal year, and it's going to get larger as time goes on if you use the ongoing structure that is now built into the system. Most fascinating thing about deficits is people complain about them, but they never do anything about them politically. And the reason is that when politicians are confronted with, would you like to spend or would you like to tax? They like to spend. Do they want a tax to cover it? I'm going home. And the problem that we're getting into now is something which we've had historically. It's only when inflation emerges as a consequence of the Federal Reserve ultimately monetizing the actual deficit, because what happens when the deficit doesn't get funded is the economy weakens, and so the automatic response of the Fed would be to expand. But the problem, obviously, is if you do that, inflation takes hold. What is fascinating is we've gone through long periods of very large deficits without the political response.
Alan, you track economic data very carefully. I don't see any signs of an impending recession.
There's no pending recession. I agree with that, and I think one of the reasons is that we have a situation in which the pressures are not yet strong enough to make a big contraction. But what we do have, and we see it in the last several weeks, is continuing claims for unemployment insurance have all of a sudden flattened. Well, in fact, if I could find the chart here, we can show everybody the chart. But yeah, here it is. It's the bottom part of the chart.
So that's actually quite a significant turnaround.
It's a very significant turnaround. And if you go back historically, it's not a bad indicator of the inverse.
Yeah, this turn up here since October.
That's suggesting that these are the most recent data. The employment figures, the payroll employment figures, come in after this, obviously. And this is as good an indicator as I have in estimating what the actual figure is likely to be, because it's the inverse of the employment numbers. And that suggests that we're going into a period which was 2.5% real growth rate, and I think we're slipping under 2%. But there's no really significant change.
But the debt that is there, corporate debt, is huge. Student debt is what, $1.5 trillion? And I actually was curious to ask you a question about that. And of course, we read today in Axios and New York Fed numbers that we're like 7 million people are behind in terms of car loans. So if we're seeing those numbers, and students, if they have those loans, we've never had an economy where our students were burdened from age 18 to 22 getting into the labor market versus us getting loans or mortgages later in life. It's very different when you basically get so burdened when you come out of school that you cannot spend, you cannot save, you cannot buy a car, you cannot buy a house. How is that going to impact things, going back to what you just said?
So could we get a recession caused by excess debt?
It usually doesn't happen that way.
It usually doesn't. But 1990, didn't we have a...
I'm sorry, I was just about to say, you're talking about this somebody has yet to come up with a particular congressional initiative which forgives X% of the debt. Now, who is going to vote against that? The taxpayer? No.
And also, it's a very US-centric issue. So students in the US are left with this kind of debt. Students in Europe and in China don't have this kind of, or Japan do not have this debt. So we cannot say that there is no impact on the future.
No, I would agree with that.
Jumping into Europe, we haven't got into the Brexit yet, but I'm very curious. Both of you know the UK economy extremely well. And it was interesting yesterday, the governor of the Bank of England was talking about how a Brexit problem can impact not just the UK and Europe, but potentially global growth. But looking at it more narrowly, just at the UK and Europe, what do you think is going to be the outcome of what Mrs. May is doing?
I think they've got themselves into a bind because they know what they don't want. Mm-hmm. That's why they voted for Brexit. Now they can't agree on what they want.
Well, see, that's not inconsistent with what...
No, absolutely. I think it's driven largely by non-economic issues, and principally immigration was a central problem. What does that lead to? I think it probably leads to a no-deal Brexit. Which the one thing I've always been impressed by the UK, though, is it has this fantastic safety valve, which is every time it looks as if it's going to, the economy is going to really tumble, the exchange rate goes down substantially. I think the single best trade at the moment is to short sterling. It's at 129. I think we'll definitely go down to the low 120s, and I think we'll probably go even further.
One last word on emerging markets. That has been seeing the largest flows this year. What is your thinking? Is it going to outperform or underperform developed markets?
I think it's going to outperform just because it's underperformed for so long. Mm-hmm. And that emerging markets are cheap. I mean, I don't,
but isn't that in the definition?
Well, typically the emerging markets are riskier and should actually give you a higher return. But we've had these giant cycles of 5-10-year periods.
Yeah, no, you make a good point.
Where emerging markets have done very well, and then 5-10-year periods where they've done very badly.
That would have nothing to do with the broad economic.
Yeah, and I think we've come through a 5-10-year period where emerging markets have substantially underperformed developed markets. And at the problem with being a value investor and saying something is cheap is it's not great on timing.
Right.
It's not in the economic growth rates, which are higher.
Right.
But in the for valuation,
exactly. That it's unusual. So I don't know. Probability that emerging markets over the next 5 years do better than developed markets, I think, is
possible.
high.